Welcome to the future of investing. Today we're diving into the ESG boom. Why sustainable investing is the stock market's next big breakthrough. ESG stands for environmental, social, and governance. It's a framework that's transforming how we invest. Investors are no longer just chasing profits. They want their money to make a difference, to protect the planet, empower people, and ensure ethical leadership. This shift is reshaping the stock market, and it's driven by a surge in demand for ethical portfolios, backed by cutting-edge innovations in material science. In this video, we'll explore why ESG is booming, how it's changing the way we invest, and why it's poised to be the next big thing. Let's start with the basics. What exactly is ESG investing? At its core, ESG is about evaluating companies based on three key pillars: environmental impact, social responsibility, and governance practices. The environmental pillar looks at how a company affects the planet. Does it reduce carbon emissions, use renewable energy, or minimize waste? The social pillar focuses on people. How does the company treat its employees? Does it promote diversity and inclusion? What's its impact on local communities? The governance pillar examines leadership. Is the company transparent? Does it have ethical business practices? Are there fair policies for shareholders? Together, these pillars help investors make informed choices. They can align their portfolios with their values, while still aiming for strong financial returns. Now, you might be wondering, why is ESG suddenly so popular? The answer lies in a perfect storm of factors. First, there's growing awareness of global challenges. Climate change is no longer a distant threat. It's impacting economies and markets today. Extreme weather events are costing billions. Investors see the risks of ignoring environmental issues. Second, social issues are in the spotlight. Movements for equality and fair labor practices are gaining traction. Consumers and investors want companies to take a stand. Third, governance scandals have shaken trust. High-profile cases of corruption or mismanagement have shown the importance of strong leadership. Finally, younger generations are driving change. Millennials and Gen Z prioritize values over profits. They're investing in companies that reflect their beliefs. In fact, a 2020 study by Morgan Stanley found that 95% of millennials are interested in sustainable investing. This demand is fueling the ESG boom. Let's look at the numbers. The Global Sustainable Investment Alliance reported in 2022 that global ESG assets reached $30.3 trillion. That's a massive increase from just a decade ago. In the US alone, sustainable investing assets hit $8.4 trillion in 2022. According to the US SIF Foundation, by 2025, ESG assets are projected to reach $50 trillion. That's over a third of global assets under management. This growth isn't just a trend. It's a fundamental shift in how markets operate. But does ESG investing actually deliver returns? Skeptics argue it sacrifices profits for principles. But the data tells a different story. A 2019 study by Morgan Stanley compared sustainable funds to traditional funds from 2004 to 2018. It found that sustainable funds perform just as well, if not better, than their traditional counterparts. Morningstar reported in 2020 that 80% of ESG funds outperform traditional funds over a 10-year period. Why does this happen? Companies with strong ESG practices tend to be more resilient. They manage risks better, like regulatory fines or reputational damage. They also attract loyal customers and top talent, which boosts long-term growth. Let's break down each pillar in more detail. Starting with the environment, climate change is a defining issue of our time. Companies that ignore it face serious risks. New regulations are cracking down on emissions, and consumers are demanding eco-friendly products. Take renewable energy, for example. Solar and wind power are booming. In 2024, clean energy accounted for 12% of global electricity, up from just 5% a decade ago. Companies like NextEra Energy, a leader in renewable energy, have seen their stock soar. Investors are betting on green technologies, and it's not just energy. Material science is revolutionizing sustainability. New materials are making industries greener. Take biodegradable plastics. Companies like Danimer Scientific are developing plastics that break down naturally, reducing the 8 billion tons of plastic waste that currently pollute our planet. Another breakthrough is in sustainable construction. Materials like carbon-neutral concrete are cutting emissions in the building sector. Companies like Holcim are leading the way with eco-friendly cement solutions. These innovations aren't just good for the planet. They're creating new market opportunities and attracting billions in investment. Now let's move to the social pillar. This is about how companies treat people, from employees to suppliers to communities. Investors are paying attention to issues like workplace safety, diversity, and fair wages. For example, companies with diverse leadership tend to outperform those without. A 2020 McKinsey study found that companies with gender diversity are 25% more likely to achieve above-average profitability. Racial and ethnic diversity, that boosts profitability by 36%. Investors see this as a competitive advantage. Companies like Microsoft and Salesforce have made diversity a priority, and their stock performance reflects it. Social responsibility also extends to supply chains. Investors are scrutinizing labor practices to avoid companies tied to exploitation. Take Nike, for instance. It faced backlash over sweatshop allegations, but has since improved its supply chain transparency, making it more attractive to ESG investors. Finally, let's talk governance. This is about how companies are run. Good governance means accountability, transparency, and ethical leadership. Poor governance can sink a company. Look at Volkswagen's emissions scandal. It cost the company billions and eroded investor trust. On the flip side, companies with strong governance, like those with diverse boards, tend to make better decisions. A 2021 study showed that board diversity correlates with higher financial performance. Investors reward companies that prioritize governance. So how do investors actually use ESG? There are several strategies. One is negative screening, like those involved in fossil fuels or tobacco. Another approach is positive selection, investing in companies that excel in ESG, like leaders in clean energy or diversity. There's also shareholder activism, where investors push companies to adopt better ESG practices. For example, in 2021, activist investors forced ExxonMobil to add climate-focused directors to its board. These strategies are made possible by ESG ratings and data. Firms like MSCI and Sustainalytics score thousands of companies based on their ESG performance. MSCI, for instance, rates over 8,500 companies, giving investors clear benchmarks. But ESG investing isn't without challenges. One big issue is greenwashing. When companies exaggerate their ESG credentials, in 2025, German prosecutors fined DWS 25 million euros for greenwashing after it overstated its sustainable investments. This highlights the need for transparency and better ESG reporting standards. Organizations like the Global Reporting Initiative, the Task Force on Climate-Related Disclosures, are working to standardize ESG data. Another challenge is inconsistency. Different rating agencies use different metrics. This can confuse investors and make it hard to compare companies. Despite these hurdles, the ESG boom is unstoppable. Governments are stepping up. The European Union, for example, has introduced strict ESG disclosure rules, forcing companies to report their sustainability efforts. In the UAE, regulators are promoting gender diversity, requiring at least one female director on corporate boards. These policies are creating a ripple effect, encouraging companies to prioritize ESG. So, what does this mean for you? If you're an investor, ESG is an opportunity. You can build a portfolio that reflects your values. Without sacrificing returns, start by researching ESG funds, like those offered by Vanguard or BlackRock. These funds focus on companies with high ESG scores. You can also use robo-advisors, like Betterment or Wealthfront, which offer ESG-focused portfolios. If you prefer individual stocks, look for companies with strong ESG ratings, like Tesla for its clean energy focus, or Unilever for its sustainable supply chain. But be cautious. Always check a company's ESG claims to avoid greenwashing. Look for third-party ESG ratings and read sustainability reports. If you're new to investing, consider consulting a financial advisor. They can help you navigate ESG options. The ESG boom is more than a trend. It's a movement. driven by investors who want to shape a better future, supported by innovations in material science, and backed by solid financial performance. As of April 2025, the momentum is clear. AI is the stock market's next big breakthrough. Thanks for watching. If you found this video helpful, please like, share, and subscribe. Let's keep the conversation going. See you in the next video.